Hi, my name's Leon Rowe, currency trader and trading coach at trading180.com, and welcome to this week's Supply and Demand, Forex, Gold, and S&P Fundamental and Technical Analysis for the week ahead, starting the 11th of November. I hope you all had a great trading week. It was definitely a busy week last week, and I hope you all stayed safe out there in terms of risk management. And yeah, getting into this week, so lots to talk about. In the United States, all eyes will be on consumer and producer inflation data, retail sales, and speeches by Federal Reserve officials as investors seek clues on the Fed's monetary policy outlook in the wake of second Trump presidency. Additionally, updates on industrial production and export and import prices are expected in China. New yuan loans, fixed asset investment, industrial production, retail sales, and house price index will be central. Across the Atlantic, the UK will release key indicators, including its unemployment rate, wage growth, Q3 GDP figures, and industrial production data. Germany's ZEW Economic Index, Sentiment Index, will also be in focus. GDP growth rate for Japan will be closely monitored. In Australia, the unemployment rate, NAB, business confidence, and Westpac consumer confidence indexes are expected. So lots going on in the upcoming week. Now, starting on the dollar and looking at the dollar index, and the big news of last week was Donald Trump, getting his second presidency, right? And so what effect really does that have on the dollar is what traders really want to know. So it says here that Donald Trump quickly put his stamp on financial markets as his victory in the US presidential election propelled Trump trade plays across assets. So really from a macro perspective, the impact of Donald Trump's presidency will have an effect on lots of assets, from forex currencies to bonds and bond yields to commodities and the stock market and indexes, right? And it says here, the swings send a clear signal that investors believe a second Trump administration will look a lot like the first one. A stream of policies, so tax cuts, deregulation, and tariffs that will simultaneously stoke economic growth, corporate profits, and inflation. And again, so what does that mean for really the US dollar? And I'll explain it now. So I did put out I guess a survey questionnaire, and I said that I asked if Donald Trump policies are considered to be inflationary. If this turns out to be correct, the Fed are likely to do what? And 62% of you got it right and cut interest rates less than previously expected. So you have to understand that monetary policy is one of the main drivers, or if not the main driver, of currency value over time. And so monetary policy meaning whether central banks are hike, hold, or cut rates. So if you're looking to cut rates, you're actually looking to devalue the currency. If you're looking to hike rates, you're looking to appreciate the currency. And if you're looking to hold rates, then you're kind of happy with where the value, which is kind of inflation, is, right? So interest rates are driven really by inflation and GDP. Now, the explanation for that is that the Fed is currently on a rate cutting cycle. Yeah. So the reason why they're on a rate cutting cycle is because inflation is coming down to their 2% target and may overshoot their 2% target. So it could go to actually, maybe 1.8, 1.6, maybe even beyond that, right? But the Fed are cutting rates in alignment with inflation, and so the way to look at it is like this. Try to look at it like there's a cycle, and I kind of explain this in the YouTube video. I'll try and put this up in the top right hand side in terms of the link, so you can click on that. Right. So imagine you've got three cycles, and the top one is interest rates. The middle one is inflation, right? And then you've got GDP. And so they pretty much all align. So If you have interest rates that are being cut, right, an interest rate cutting cycle, it typically means that inflation is coming down and GDP is in the contraction phase of the economic cycle. And if you have interest rates that are rising, you typically have inflation that is also rising and GDP. That would be growing. So, recovery, the expansion and the boom phase of the economic cycle. Now, interest rates and GDP are what typically will indicate whether the central banks will hike, hold, or cut interest rates. And so, if you know that the Federal Reserve or any central bank is looking to potentially cut rates, yeah, then you should know that inflation is coming down or maybe beyond their 2% target, right? So, 2% target is normally the central bank's mandate, right? So they're mandated to get inflation down to their 2% target. Now, if the central bank are less likely to cut, yeah, remember, cut means to devalue, right? Is devaluation of a currency. That's what the aim of a cut is. Doesn't necessarily mean it will, but that's what they're attempting to do, to devalue the currency, depreciate the currency. Um, if there are less cuts coming, yeah, what it means on the cycle is that inflation isn't necessarily too much of a problem. And so let's say, for example, this is the 2% mark, and if inflation continues to maybe, or is forecasted to maybe go to 1% or 0% or -1, which is considered deflation, then of course you have to continue cutting rates in order to try to prevent inflation from going that low and trying to remain at 2%. Now, if the central bank is saying, oh, well, right, well, we're going to not cut as much, we don't need to cut as much, it means that they have inflation under control. So, in fact, the cycle may look something rather than a deeper cycle. The inflation cycle may, look like it's leveling off a lot sooner, which, if that's the case, then interest rate cuts will be leveling off a lot sooner. Yeah. And so if they have to cut less because inflation is okay, as the article was talking about, the policies are seen as inflationary, and also as well, there's a return to some sort of economic growth. So again, not necessarily heading into the contraction phase or the bust or slump or recession phase, right? We're leveling off, yeah. Then there's less need for rate cuts, right? So if there's less need for rate cuts, there's less need for the market, for the Fed and any central bank to devalue their currency. Right. And if they're not devaluing their currency because they're not cutting as much, or there's less need to cut as much, then in fact the currency, right, whether it's the dollar, whether it's the pound, whether it's whatever currency, will end up strengthening, right, because those cuts need to be priced out of the market. The market normally tries to price in data, maybe 3 to 6 months ahead of time. And so if data comes out supporting the fact that Donald Trump's policies are inflationary, right? So rising inflation, less need for, cuts. Yeah, because on top of that, you've got, potentially a growing economy, less need for devaluation. So 62% of you got it right, yeah, in the short term. So the Fed are less likely to, cut rates than previously expected. And so when we look at the dollar, right, this was a buy the rumor, sell the fact situation. So Donald Trump winning was seen as a possibility, more of a probability than Kamala Harris winning. And so the market, way ahead of time at the beginning of October, decided that they thought that that was the likely outcome. And now you're getting, of course, dollar strengthened, and that has been now confirmed, right? And so ultimately, for me, the dollar is going to continue to be a buy for the foreseeable future. Now, that doesn't mean that prices can't pull back. Of course, prices, can and they will pull back, right? And they do pull back. Just because the dollar is potentially pulling back, maybe over the next week or two, if it does, I don't know whether it will, but if it does, it's okay, right? You just look at these areas as buying opportunities. That's the key to this. So don't ask why the dollar is falling. It doesn't necessarily really matter too much. Of course, you do have to ask the question. But if the fundamentals are suggesting that nothing has changed, then you just look at this as buying opportunities. Because the last thing you want to do really is buy high and sell low. The mantra is buy low, sell high, right? So buy on pullbacks. Of course, some traders have breakout strategies, etc. That's fine. But ultimately, in the way that I trade, I look for pullbacks. I'm looking to buy low. So for me, I'm looking for confluence of any kind of dollar pullback, dollar index pullback to a cheaper area, a nice demand zone with the confluence of some support, right? Support resistance. In this case, it would be support there and possibly around here. Yeah, we've got it. Got something about there as well. The deeper the pullback, the better, of course. So if the dollar can pull back to any of these areas, this is where I'm looking to, continue to get long. Also, as well, again, that's from the election perspective, but again, just looking at really the confirming really that the Fed are likely to, and looking for evidence really that the Fed are looking to cut rates a little less than what is forecasted. This is from ING. A more gradual rate cut profile looks likely in terms of where we go from here. Inflation is looking better behaved, right? And the jobs market is cooling but not collapsing. So the Fed is in a position to continue loosening monetary policy closer to neutral gradually. We think they will cut by 25 basis points again in December, but the outlook thereafter is less clear, and there is a strong chance of a pause at the January FOMC meeting. So again, less need for cuts potentially, which should continue to strengthen the dollar overall, right? We're not looking at, a 5-minute chart and asking why isn't price going up today. We're looking at this from a daily, a weekly time frame, waiting for those pullbacks and then looking for decent levels in order to get long. So for me, dollar buys for the foreseeable future. Looking at the dollar yen and the dollar yen, for me, I think the dollar yen is again more of a buy, although um, the Bank of Japan are looking to hike rates. I just don't think there's enough hikes in order to justify buying the yen against the dollar. Right now, the yen can be a buy against other currencies, maybe like the euro, maybe like the Swiss franc. But in terms of the dollar yen, I think the upside potential is still really more the path of this resistance is still more to the upside. Now, I do think that might be a bit on the still on the expensive side when we consider where prices have been and where we are at these kind of highs. I would prefer if prices kind of came down to maybe the 150s, 149s. I think that's a much better bargain price to look for any kind of long trades. But if you are looking to get involved, somewhere around the 150s, then I think that level there is actually quite nice. It's also looks like a bit of a stop hunt as well, potential stop hunt around that level. So yeah, there is rumors as well that the Bank of Japan could look to hike rates this year, but the general consensus is that the Bank of Japan will likely hike next year. But again, the hikes I think are so small that the question is what would make investors really come out of a higher yielding currency like the dollar and go into the yen, which is still quite a low yielding currency in terms of interest rates. I think they're at 0.25%. So whereas the dollar, even though the Fed are cutting rates, they're still around that 5% mark. So it says here, Donald Trump's US presidential election victory intensifies uncertainties for the Bank of Japan, with the yen's weakening in the wake of the outcome, a potential catalyst for near-term rate hike if the trend extends further, according to a former executive director in charge of monetary policy. So, again, if we continue to get a lot more upside, right, it means that the yen is weakening. And if the yen is weakening, it means that inflation is increasing. And if inflation is increasing, which is something that they don't want, then they have to potentially hike rates. Right? That's what this is explaining. Uncertainties got elevated not only for the Bank of Japan but for everyone around the world as a result of the election. Kazuo Moma, the former Bank of Japan executive, said in an interview Thursday, pretty much the only reason the Bank of Japan might raise rates early would probably be a rapid weakening of the yen. So again, a rapid weakening would have to be something like, where you've got prices kind of move parabolic. If you get more of a gradual increasing of the yen, then it's less or devaluation of the yen, sorry, and dollar yen increasing, then it looks like that might be a lot less chance of a rate hike. But for now, a rate hike in January is logical given that the central bank has indicated it will be raising the benchmark from the current 0.25% to roughly 1% by around the end of the fiscal year through March 2026. Mama said he sees the hiking cycle advancing at about one move every 6 months. So again, yep, they are on a hiking cycle, and hiking typically does have the effect of strengthening a currency and appreciating a currency. But are those hikes from the yen enough to tempt the um, I guess investors into buying the yen enough against a currency like the dollar, where the dollar is seen and the Fed is seen to be cutting less. So my opinion is that the path of this resistance should be continued to the upside. So any pullbacks down to any of these zones, I think, are decent buying opportunities. Dollar Swiss, pretty much the same buys on this currency pair for me is what I'm looking at. So if we can get any pullback into this zone, the 86 round number or close to it, that's where I'm looking at buying really. The dollar Swiss, the Swiss franc, and the Swiss National Bank are still in their cutting cycle, and they have inflation problems or deflation problems, I really should say. So for me, this is a really nice area to look for a buy trade if we can get prices pulled back. If not, then we may have to wait for a pullback into a demand zone like that before going long. Uh, Dollar CAD. So again, for me, dollar CAD should really be a buy. I don't think. I think the Bank of Canada is still continuing to cut rates more than the Fed. So again, any pullbacks, we did bounce off of this level here, but any pullbacks into this area, I think, are decent buying opportunities. I think here was a level of support and resistance as well. Yep, you can see it there. We got resistance, bit of support there. So it has been traded by the institutions. So any pullbacks into this area here, I think, is decent for a potential buy. But preferably, I would wait for prices to move, down to there. Bit of a deeper pullback I would prefer. So pound dollar, pound dollar, uh, the pound, uh, again, Bank of England had some came out and was a little bit more hawkish, to be fair. Yeah, a bit more hawkish. Where did I put this? Right, here we are. So they did cut as well last week, but the pound rose as traders paired bets on further Bank of England monetary easing with the outlook for price pressures, basically inflation, clouded by increased UK government spending. So, government spending, we had the Labour budget a couple of weeks ago, and that is seen as being inflationary. So again, exactly like um, the US, because the new government policies are seen as inflationary, there's less likely for rate cuts, and so rate cuts are being priced out, which basically is the reason why. the pound is kind of strengthened a bit because there's less need for the devaluation of the currency. So it says here the pace of cuts from here has been muddied by the recent political developments, said Zara Noakes, global market analyst at JP Morgan Asset Management. The UK is now contending with a number of cross currents which make the growth and inflation outlooks highly uncertain. But it says here markets are now pricing around a 15% chance of another quarter point cut in December. So basically there's an 85% chance of a hold, right? So whereas before, the government budget, the market was pricing in the odds of a cut in December, but now it's quite a low uh, chance of a cut, right? And it was before, it was 25% actually before the decision. So there's less likely of a cut the market sees, but now than before the election. Further ahead, swaps implied two more cuts in 2025 with a 50% chance of a third. That's less than what's expected from the European Central Bank and the Federal Reserve. So, in fact, the Bank of England are seen as cutting less than the Fed and the European Central Bank. So, what does that mean? That means, I think, at best we should be bottoming out really on the pound dollar. Um, so you could look for buys or sells. Um, Most likely buys, but I'm not really interested in this pair. I don't think the divergence is a lot. But if you are looking to buy the pound dollar, I think any pullbacks down into that zone is a decent should be a decent sell. If you're looking for, sorry, at least decent buy for the pound. If you're looking for a sell trade and looking to buy the dollar, then I think any pullbacks up into this area here where you've got also some support and resistance, right? Should be decent. Maybe just above that, but you've got a fresher area of supply. But you can make the case for buying or selling the pound against the dollar. So again, not really a pair. I look for bigger divergences between monetary policy. But yeah, you've got that for the pound dollar. Pound yen, again, not really a pair that I'm too interested in. But if you are, then you do have, in fact, this area here to look for a buy trade if you're looking to buy the pound. If you are looking to short the pound against and buy the yen, there's that area there. In fact, probably draw it from around from the highs here. We've had some supply there, yeah. So this is where we have a nice confluence of some resistance in that area there. So yeah, basically a pullback into this zone if you're looking for pound yen buys. If not, you do have a level just below that as well within that wider area of demand to look for, I think. A buy trade for the if you're looking to buy the pound, if you're looking to sell and buy the yen, then you're looking for really a pullback up into the 200 round number right there. So yeah, again, not really interested in this currency pair at the moment. But I am interested in the next currency, which is the euro. So this is the euro index, right? And I've added this to the analysis just to give you a bit of a perspective. And so the euro equally weighted index um, is definitely a should be looked at. And again, I'll put the link to really to understand how to add the equally weighted indexes for all currencies on the top right hand side. So yeah, basically for me, whenever I'm looking for a trade, I'm looking to buy low, sell high, right? Now, I'm looking to short the euro, but the euro at the moment you can see is basically sold off. And so I have to wait for a pullback into a level, right? Or if it makes lower, lower, lower highs and then a pullback into a level there, right? So you don't want to sell at lows and buy at highs. You're looking to, waiting for a pullback, right? So the euro for me is a sell. And really, the main reasons why is kind of explained in this article. And it says here that currency traders are turning against the euro as Donald Trump's victory in the US presidential race boosted the chance of aggressive European interest rate cuts, driving the common currency toward parity with the dollar. So, differing trajectories on interest rates in Europe and the US are forcing strategists to reconsider their predictions. While Trump's policies are seen as fueling inflation and curbing the Federal Reserve's ability to cut rates, his promise of global trade tariffs could crank up the pain for Europe's sputtering economy, requiring steeper easing by the European Central Bank, with the Fed raising rates or keeping rates high to fight inflation, just as the ECB continues to lower rates, likely at an accelerated pace. The widening interest rate differential is likely to weigh on the euro, possibly hitting parity, said Georgette Boelli, a strategist at ABN AMRO, who correctly predicted the euro and the dollar hitting that level in 2022. So, again, looking at the euro dollar, right? Um, we got two central banks which are on slightly different paths. We already know that the Fed are looking to cut rates. Reduce the amount of rate cuts that they're looking to do, whereas the European Central Bank, in fact, may accelerate those cuts and maybe have more cuts, right? And so that's being reflected in what we're seeing in recent price actions. So ultimately, yeah, for me, a pullback into a zone will be nice. Or if this continues to make lower lows, then you'll have a supply zone here, and then you're looking for a pullback into that supply zone before, sorry, looking at some short trades. So the path of least resistance is still to the downside, right? Still to the downside. But for now, you don't want to sell at lows, or you can sell at lows if you want, of course, if that's your technical strategy. But for me, I'm looking for pullbacks into areas to look to sell the dollar, sorry, the euro for a better short. So yeah, euro dollar not looking great for any kind of euro bulls, and understandably, you can understand why that's happening from a monetary policy perspective. Euro yen, so euro yen, I think should be a bit more of a short. Reason being is because, again, you've got maybe more aggressive cuts happening for the euro, whereas the yen are looking to hike very gradually. And I do think that the upside, with the dollar kind of, and Trump's policies weighing on the euro. And also as well the Bank of Japan looking to hike rates, even though it's a small amount. I think the euro's strength, I think, is definitely expensive up at these exchange rates. So I think any pullbacks into that level should be a nice short. Of course, if you do want to look to buy the euro then against the yen, then you do have a nice demand zone there. But I do think that the we should want to roll over a bit more, or at least any upside should be capped on the euro. Of course, this is all data dependent. Nobody knows. If the data comes out supporting less euro cuts, then of course, then you may want to look for buys on this. But for now, it does look like, I think I'd want to look for short trades rather than long trades on that pair. Euro pound. This was, I really wanted to get involved in this to the short side. Didn't really take any. I only took one trade before the election, as I was kind of concerned about the volatility, and I was looking for short trades actually up here, and the trade actually worked out. But ultimately, risk management is the order of the day. But when it comes to both central banks and which direction you should look to trade in, or I'm looking to trade in, the path of least resistance is still to the downside, right? We just, went over the pound, went over the euro, and the analysis is that the Bank of England are looking to cut rates less than the European Central Bank. Therefore, any pullbacks really should be shorting opportunities on this. Again, if you pull back to any of these zones, that should be a nice short. Aussie dollar, the Australian dollar fundamentally is, from a monetary policy perspective, really should be one of the better currencies. Their central bank are not really looking to cut interest rates until next year. So, like I said, from a monetary policy perspective, we really should be buying the Australian dollar. The downside to really buying the Australian dollar is that it is affected by, or will be affected by, the Trump tariffs on China. And so, if Donald Trump, gets engages in a trade war with China, it will hurt China's economy. And Australia does a lot of business with China, and if China have kind of got their hands tied and their economy isn't growing as much, it means that the Australians can't or won't be able to export as much of their commodities, right? Because the Chinese government may put a hold on any new infrastructure projects if they see that their economy is actually slowing down, and therefore putting a hold on infrastructure projects means that they're going to not necessarily be importing as much from Australia. Australia don't have, can't necessarily sell as much commodities for their infrastructure projects. Therefore, Australia's currency and economy will suffer a little bit. And so there are those fears in a risk off environment. Commodity currencies don't necessarily do well. So, although I am bullish on the Australian dollar, I've got one eye on the risk sentiment side of things, and what goes on, with China, and how the Chinese economy is affected. So, um, but for now, I wouldn't necessarily be buying or even trading this currency. I do think that, from a risk off perspective, of course, the dollar would have the edge. So continued sells. So you'd look for really kind of sell trades at within that area of supply. And when you have a wide area of supply, all you're doing is trying to break this down in terms of support and resistance zones. Somewhere around there should be decent. Yeah, so maybe somewhere there. So if prices do pull back to this area here, and you're looking for a sell trade, or if you're looking for a buy, and you think that maybe we might even start to auction or range within this 0.67 to 0.65, 200 pip range, then you're looking for a buy trade around here. But this is not a currency that I'm really interested in trading. Looking at gold now, gold, a little bit of a tricky one to be fair, because there's reasons to buy and sell gold. The reasons to kind of buy gold would be that the Federal Reserve is still on their cutting cycle, right? And so, although yes, they are likely to cut less, they are still cutting. So there are reasons to buy gold. I don't think gold is going to necessarily get all the way up to its highs anytime soon. With Trump coming in, of course, there's an inflation risk as well. So, gold, being historically seen as a hedge against inflation, again, is another reason why you may want to look for potential buy trades, on pullbacks. The reasons to kind of sell gold would be because the economy, the US economy, may do a lot better with Trump being in power. So, if the stock market is positive, and you can get higher returns on the stock market rather than holding gold, yeah, then money's going to flow out of gold and into a higher yielding asset class, which would be, stocks and stock markets. So you could start to see traders looking to take profit. All uh, the fundamental traders who are buying and holding from all the way down here, who have made money all the way up here, now can start to, take some profit off, and that obviously begets selling. So, yeah, those are the reasons really to look for some sell trades. So we could obviously see, I say obviously, but we could see now prices start to auction between range between certain price zones. So reasons to buy, reasons to sell gold. I mean, I'm always a long term buyer of gold and silver, but when it comes to trades, you got to be a bit more, you got to time it a bit better. But yeah, like I said, reasons to buy and reasons to sell gold. So you can go long or short at levels. And the S&P continues to make higher highs. Um, so as I said, Trump's policies are seen as being uh, good for the economy, right? And corporate bonds. So ultimately, you're really looking for a pullback. Again, path of these resistance should be to the upside and continue. So again, pullbacks. If we can get something like that, that would be brilliant. Or you may get maybe price bounce off of what would be considered a support or resistance area, right? So resistance there, and then if you get something like that happen, then that would create demand at that area, and then you're looking for a pullback into that zone to look for some long trades. I don't trade support and resistance like this. I'm definitely looking for more evidence that prices are a bargain before looking at support and resistance confluences, but prices need to make a higher high before I would consider buying really at this area here. So um really, yeah, those are the options, right? And for the foreseeable future, unless again some sort of risk event starts to take hold, I don't know, some sort of uh, who knows, some banking crisis, unforeseen event, the S&P really should continue to make higher highs over the medium to long term. Who knows in the short term, right? So yeah, that brings us to the end of the analysis. Only really in one trade, right? So it was the Aussie Swiss. I could have gotten into a few trades before the election, but I chose not to. I thought the Aussie Swiss might be one of the least affected currencies by volatility as the elections were coming up. So I kind of just stayed in this trade, which I entered on the 30th of October. So this was the last trade I entered, and the only trade that I'm really in. And this was a profitable trade. So I didn't enter into four trades. In fact, I entered into three. Yeah. So I got into three positions. So the original market entry was here, right there. And then I had a buy pending order, right, at the 0.5685 area. So that was a buy, and then prices came down to the 0.567 area, right? And I bought around here. Now, each of these stop losses were 15 pips below here, below the low right there. And I was saying to the traders in the private members group that I nearly got stopped out. It's probably maybe around about a pip or two for being stopped out on that Thursday, the first of October. But that ended up being actually a stop hunt, right? And then prices came back up, and as prices started to come back up, right. So what I'll do is I'll move this down a bit, right. So as prices started to come back up, and I got triggered into all three, then it was a case of taking some profit off, right? So got a one-to-one trade as prices came up to around there. One second, let me just move this over. Right. So this position, the lower position here, ended up hitting a one-to-one there. And the second position right here, I actually held it a little bit longer than a one-to-one. I think I held it to somewhere around fair value, somewhere around here. Um, So that was the second trade that ended up being a nice trade. And then the higher entry, which was here, I took off 50% as we hit this level there. So that dotted line was 80% of the auction, so the range. So this high, yeah, if you zoom out a bit, That's been the high for quite a few months, the high of October. So I anticipated that price was going to remain in this range. And so 80% targets, a decent area to look for, to take profit. So that area, that zone basically is 80%, right? And so what I did is prices came up. I decided to take 50% off. Right, so 50% profits off. Trail my stop up, by the way. My stop loss is I think is at 35. So my stop loss is here now. Um and yeah, so this has actually been a really profitable trade. Now I'm gonna hold the remaining 50%. If I get stopped out, it is what it is. It's just I can't lose from here. But I'm looking to actually now hold this to maybe the 60 cent area and see how long that takes and just keep trailing my stops up until and hopefully we can I can avoid being stopped out and hit that 60 cent area. So yeah, that's really the trade, and that's the only trade that I'm in at the moment. Now just waiting really for some new trades now that the dust has settled over the presidential election. So that's it for this week. I hope you all have a great trading week. Take care and all the best.